quick way of introduction, my name is Nathan Fowler, and I'm an attorney with Hansen Johnson, and I practice in our tax group. As a quick disclaimer, though, I have to say that, yes, I'm an attorney, but this presentation, we will not be providing any legal advice, so there won't be any attorney-client privilege created. This is just for informational purposes only. So today we're going to be talking about some key tax provisions that are impacted with the coronavirus, some of the acts that have been passed, and how those may or may not affect individuals and businesses. Just a quick update on the economic stimulus bills the economic stimulus payments that are going out. As many of you probably already know, that's $1,200 per individual. If your income is less than $75,000, it bumps up to $150,000 for a couple. So that'd be $2,400 per couple, and then an additional $500 per child. Those deposits are expected to be made, from what I'm reading, the last news is around the week of April 13th, so possibly next week. Those would be coming into made via direct deposit. And if you filed your 2019 tax return, they'll be using the bank account information from that. Otherwise, if you filed your 2018 tax return, to get that information from there. Okay, and then turning to your tax returns. The tax return deadline, the extension was extended both for individuals and businesses. So for the federal tax return, that deadline was extended to July 15th of 2020. And for the state of Idaho, that deadline was extended to June 15th of 2020. And I want to be clear, today we'll be discussing both federal impacts as well as with the state. You may be asking, well, why does Idaho's deadline only go to June 15th? And that's because the state constitution will only allow the deadline to be extended for tax returns through that time. So again, it's July 15th for the Fed and then June 15th for Idaho. I thought I'd just quickly touch on a high level with payroll taxes. Again, this whole presentation is going to be a summary, a very high level. We try to keep it to about 30 minutes, just so we can be conscious of everyone's time. And if you have any specific questions, don't hesitate to reach out to us via our website. You can call our office at 208-384-8588 to set an appointment to discuss some specific questions you may have. But going to the payroll tax credit for employers. So on March 18th, 2020, there was enacted the Families First Coronavirus Response Act, or the FFCRA. What that does is allows employees up to 12 weeks of job protected leave if they're unable to work. For employers, it allows for a tax credit against the Social Security tax. So that 6.2% that employers are paying, they're allowed to get an offset for that, a credit on their return. Additionally, the Coronavirus Aid, Relief, and Economic Securities Act, or the CARES Act, which we'll be calling it, that was signed by President Trump on March 27th, that allows employers to actually defer Social Security payments up to 2 years. So with the first half being due by 12/31/2021, and the second half not being due until 12/31/2022. So it allows these employers to kind of defer those Social Security payments for a time. I won't go into too much detail with that, but I will direct you to our other videos that Hansen Johnson has done. My colleague, Brian Peterson, has done an excellent video on how the CARES Act and other laws have impacted employers and their tax credits there. And the links available are on our Facebook page as well as our LinkedIn page. Okay, so I'll turn quickly to tax-free reimbursement. There's a code section 139 found in the code. It's rarely used, but within the coronavirus, it now has some applications. So I thought I'd just quickly touch on that. So just a little bit of background. On March 13th, 2020, President Trump declared COVID-19 a national emergency under the Stafford Act. Same day, Governor Little issued an emergency declaration, and now all 50 states, including the District of Columbia, are now eligible for relief under the Section 139. And so you may be asking, what are those? And so these declarations under the Stafford Act have tax consequences and implications. I mentioned earlier that there's an extension to the tax filing deadline This is made possible under the Stafford Act. But there's also this thing under the Section 139 termed for qualified disaster payments. And just quick background on this. So Section 139 was enacted in the wake of 9/11. So it was passed in 2002 as a result of these terrorist attacks and the tragedies and the harm that resulted from that. And what it does is it allows an employer to make payments to an employee for certain qualified expenses. For the employee's perspective, what it does is it allows the employee to receive this income from the employer tax-free. So it's not reported on their W-2 or in any way reported as income for the employee. Now for the employer, what they can do is make these payments to the employee, and fortunately the code is very broad in terms of what qualifies for these expenses for the employer. These can include anything made to reimburse the employee for pay that's reasonable and necessary, whether that's for personal reasons, for family reasons, for living expenses, funeral expenses. So maybe some specific examples under COVID-19 could include medical expenses that are not already covered by the employee's healthcare plan. It could include childcare costs, funeral expenses, education costs related to school closures, costs associated with enabling an employee to work from home. So this could mean the employer provides the employee with the ability to have a cell phone or a computer, printer. Even the increase that the employee has in their utility costs could also be offset and paid for by this employer. So what this means is that, as I mentioned, the employee receives these funds tax-free, but at the same time, the employer is able to provide these funds to the employee and receive a business expense for that. So they would write that off on their tax return. Additionally, there's no requirement for service for the employee. So you don't have to be, there's no 90-day probationary period or anything of that nature. So the rules are pretty generous when it comes to employers making these types of payments to an employee. And there's also no formal plan that's required. The employer does not have to have a formal plan in place in order to qualify to make these types of payments to their employees. I will say that the Section 139 was drafted and intended for really the worst of scenarios. And so fortunately or unfortunately, it hasn't really been used to this point. So this will be really the first go the IRS has at reviewing this 139 and these expenses and deductions. So we would highly recommend that you speak with your tax professional or the person who prepares your tax returns to see if this makes sense for you and your business to make these expenses to your employees. We would say that if you are if you are exploring this as an option, some things to keep in mind are keeping track of amounts that you've paid to your employees, who you paid them to, and how much they received. Having a clear start and end date for this plan, and also having a general list of expenses that you as an employer would be paying for your employees. And then also perhaps a maximum amount that each employee would be eligible for, or a total overall amount that you would be willing to pay as an employer. So just some things to keep in mind. Again, Section 139, it hasn't been used very often, but if you're an employer and you're looking for ways to provide an additional support to your employees, then that might be a good fit for you. Okay, so moving on, I'll talk just briefly about some adjustments made within the CARES Act to net operating losses, or NOLs. As you may already know, in 2017, there's a major overhaul to the tax code, the Tax Cuts and Jobs Act of 2017. Within that, there was a big change to these net operating losses. So prior to that time, business individuals were able to carry back any net operating losses that they had. So they were able to file an amended return and perhaps get a refund on any losses that they had in a future year to kind of push those back. With the change in the Tax Cuts and Job Act, so net operating losses after December 31st, 2017 are now only eligible to be carried forward. There's no longer a carry back provision. So all those individuals and businesses that were used to filing an amended return or pushing back those NOLs were no longer able to do that. In addition to doing away with the carryback, they also limited the deduction to 80% of your taxable income. Before, the threshold was at 100%, but the Tax Cuts and Job Act reduced that to 80%. So some people really experienced quite a change with those net operating losses. Fast forward to the CARES Act, and now we see that those net operating losses that were in effect from that 12/31/17, there's now a provision that allows those to be carried back. So any net operating losses that were had from 12/31/17 up to January 1st of 2021 are now eligible to be carried back based on the CARES Act. Additionally, that 80% limitation is also removed for these years. So you're able to carry back, up to 100% of those losses, and you're able to claim 100% of those losses. You're not subject to the 80% limitation any longer. So what does this mean for businesses? Well, as I kind of mentioned, businesses may now file amended returns to take care of those net operating losses that were previously disallowed, which could result in a sizable refund for many taxpayers. So that's the net operating losses. In addition, there are net interest expense deductions. So with the Tax Cuts and Job Act, it provided that there would be an interest deduction for businesses, but limited that to 30% of the adjusted earnings. The CARES Act now steps in and says, well, now the limitation is increased from 30% of your adjusted earnings up to 50% of those earnings. So for both 2019 and 2020, taxpayers are able to claim an increased amount of these interest expenses if they have those. Additionally, and I won't go into too much detail with this, but for the corporate alternative minimum tax, that was done away with, repealed as part of the Tax Cuts and Jobs Act. With the CARES Act, that's now allowed corporations to claim the alternative minimum credit fully in this year. So what the Tax Cuts and Jobs Act did is it said, okay, we're no longer having any corporate AMT, but corporations, if you have this AMT, we will allow you to take a credit for 5 years going forward. What CARES did is it says, well, we'll step in now and we'll say, you know what, if you have any AMT credit available for your corporation, you can claim that this year, so to fully claim that. So anyway, that's just a quick summary on the AMT for corporations. I know it doesn't apply to many people, but I just thought I'd share that with you. Additionally, the CARES Act suspends for, now we're talking about partnerships and sole proprietorships, this thing called the excess business loss limitation. It's similar to like a net operating loss with which you're not able to claim all of your losses through your partnership or through your sole proprietorship. The CARES Act now suspends the excess business loss until 12/31/2021. So it allows you to claim those, what would have been disallowed losses on your flow through, on your partnership and your sole proprietorship returns, allows you to claim those. So that again is effective through 12/31/2021. Another change to the CARES Act is the charitable deductions that are available. Corporations were generally allowed to only deduct up to 10% of their adjusted gross earnings made for charitable contribution purposes. Now for tax years ending after 12/31/19, so for 2020 and 2021, that limit is now increased to up to 25% of the business's adjusted gross income. So there's, if you're a business owner, you're able to have more charitable contributions that you can claim on your tax return. Okay, so I'd like to talk briefly about retirement plan distribution. So Many of you may have heard that with the CARES Act, there were some changes to your 401k account or your IRA account and distributions that could be made as a result of hardships that the taxpayers are experiencing. And so the CARES Act is authorizing what are called these coronavirus-related distributions. So what is defined, what is a coronavirus-related distribution? Well, the legislation out there is deeming this what's called an adverse financial consequence because you've been quarantined, furloughed, laid off, or have had hours reduced due to the coronavirus. You're unable to work because of lack of childcare due to the coronavirus. Perhaps you own or operate a business and you've had to close because of reduced hours, or you've had to close altogether due to coronavirus. These are all qualified. And then the IRS is continuing to provide additional guidance as to what these, what they call coronavirus-related distributions are. So if you experience any other adverse financial consequence due to these ongoing guidelines provided by the IRS, that would also allow you to be eligible for these retirement distributions. So generally speaking, if you make a withdrawal from your retirement account prior to reaching age 59 and a half, then you would be subject to what's called an early withdrawal penalty. What the CARES Act does, if you fall within that coronavirus-related distribution, it would waive that early withdrawal penalty. So that 10% penalty would be withdrawn. You would not be subject to that. So what about, and these would be distributions that are made anytime during the calendar year for 2020. So if it in fact shows that these are eligible from starting January 1st of 2020 through December 31st of 2020. So if you make a withdrawal from your retirement account anytime during that year, you would be eligible for these benefits. Some might ask, well, is there a tax on these distributions? And the answer is yes, you would still be taxed on these distributions. However, under the CARES Act, you're able to pay the tax over a 3-year period. So beginning with tax year 2020. So the first year that you would actually pay tax on that distribution would be 2020, and you could spread that out from 2020 through 2021 and 2022. So the amount that that's eligible for withdrawal is up to $100,000 from your retirement account. And you wouldn't be subject to, as I mentioned earlier, to the withdrawal penalty for that. Now, generally, if you were to take a withdrawal from your retirement account and put the money back in, it would be deemed a rollover. And you have 60 days to do that without being subject to any early withdrawal penalties or any tax on that amount. Under the CARES Act, that 60 days is now extended for an entire 3 years. So the caveat here is that you have to put back in the entire amount of the withdrawal to avoid paying any tax on that. We are expecting additional guidance from the IRS regarding this, but under the CARES Act, what they're showing is that, one, you wouldn't be subject to the early withdrawal penalty. You would have more than the 60 days to put the money back in. If you decided that, in fact, you're pulling that out for a short term and you're able to put your money back in within the 3 years, you wouldn't be subject to any tax on that withdrawal either. Additionally, if you would like to make a loan from your retirement account, you're able to do that as well. The prior maximum amount of the loan was $50,000. The new amount is $100,000. And you're also able to withdraw the entire, up to 100% of your vested balance from your retirement account. So that's just a quick summary on the retirement accounts and making withdrawals from that. The last would be if you or someone you know is subject to what's called these required minimum distributions. So that's when you have a retirement account, you're now 70 and a half. The government requires that you pull a minimum amount from your retirement account each year, and you're taxed on that withdrawal. Under the CARES Act, that has now been waived. So if you were subject to the RMD or the required minimum distribution provisions, you're no longer subject to those provisions. You're not required to make you're not required to withdraw from your retirement account this year if you choose not to do that. So that's kind of the summary for the retirement account. Well, like I said from the beginning, I think I just wanted to do like just a very high level overview of any tax changes that are resulting from the CARES Act. There aren't any huge changes to, let's say, the tax brackets. You might want to talk with your employers as far as your withholdings to just based on your, if you've had a change in your income, if it makes sense to adjust your withholdings for the rest of the year or make any changes to those. But overall, the changes are beneficial to you as employee and employer. So I would recommend speaking with the person who prepares your tax returns to see if any of these things that we've discussed today could benefit you during this time. Okay, well, I think if there aren't any other questions, then I'll leave you to the rest of your day, and thank you for joining us. And as I mentioned earlier, please tune into the rest of our videos. We have several links posted on our Facebook page and our LinkedIn page. Several of our attorneys, Matt Christensen, has done these programs specific to businesses and how they're impacted with the CARES Act. So, and Wyatt Johnson and Shelley Foltz-Kuntz. And so we just direct you to those if you have any further questions, and thank you for participating today.